What if, what if the absolute safest place you thought you were keeping your money, like just sitting in cash under the mattress or safely locked away in a bank account, was actually the most mathematically dangerous place for it during a global crisis?
Right. It's wild to think about.
It really is. So welcome to the Wealthnetic Deep Dive. Today, we are getting into the weeds on the mechanics and really the math behind global panic.
Yeah, and specifically why the wealthiest people on Earth actively buy when, missiles start flying, while the middle class just entirely liquidates their retirement accounts in sheer terror.
Exactly. And if you are listening to this right now and you've got a significant chunk of your net worth just sitting in a high-yield savings account because you're waiting for the dust to settle in Europe or the Middle East or wherever the latest flashpoint is.
Which is a super common reaction, by the way.
Totally normal. But you are currently executing a strategy that historical data proves will make you fundamentally poorer.
Right. It is the ultimate behavioral trap. The things that make us feel secure in the short term are, well, precisely the things that guarantee our financial destruction in the long term.
Yeah, and we are drawing today's insights from a massive stack of sources. We've got comprehensive financial reports, historical market analyses going back nearly a century, and the highly documented philosophy of this legendary 94-year-old billionaire investor.
A guy who has literally compounded capital through World War II, the Cold War, and every single major modern financial crisis.
Right, he's seen it all. And to understand how to actually build wealth like that, we first have to unlearn our deepest instincts about what safe money actually looks like.
Absolutely. The framework we're pulling from his philosophy is just so essential right now when you see the headlines about, supply chains fracturing or energy markets freezing up.
Or just outright conflict on the news.
Exactly. Your brain just screams at you to run for the exit. But wealth is built by overriding that biological impulse.
Yeah.
It requires understanding the underlying machinery of how capital actually moves during a crisis.
So let's get right into the gears of that machinery. The immediate instinct during a crisis is to hold cash. I mean, it feels tangible.
It feels safe. It doesn't bounce around like the stock market.
Right. It feels immune to those violent swings. But our sources map out the reality of wartime economics. And the trap here isn't just that you miss out on market gains. It's that the currency itself is actively being weaponized against your purchasing power.
Yeah, because when a nation enters a massive systemic shock or a war, the financial burden is just instantaneous and staggering.
Oh, yeah. Tons of money needed overnight.
Right. And governments cannot simply raise income taxes overnight to fund a multi-trillion-dollar war effort.
Yeah.
I mean, the political friction is way too high and the logistics just take too long.
People would riot.
Exactly. So they utilize the two levers available to them. They issue massive amounts of debt, and their central banks monetize that debt by creating new currency basically out of thin air.
Just flooding the system with liquidity.
Right, to keep the defense contractors, the supply chains, and the emergency services operational.
I want to reframe how people visualize this, though, because the old melting ice cube metaphor for inflation.
Oh, yeah. People use that all the time.
Right. But I feel like it doesn't quite capture the malice of what's happening to your bank account. Holding cash during a geopolitical crisis is much more like owning 10 shares of a really successful company, only to wake up and find out the CEO just issued 1 billion new shares overnight.
Wow. Yeah, to pay off a massive corporate lawsuit or something.
Exactly. Your 10 shares didn't disappear. You still see them in your account. But the overall pie was just cut into microscopic slivers.
Right.
Your ownership stake, your actual claim on the real resources of the world was completely diluted.
That is a much more accurate mechanical description of inflation, really. The trap is that people think the prices of goods are going up, but they aren't. The value of the underlying currency is going down because the supply of that currency has been exponentially diluted. Early 20th century economists called this cognitive blind spot nominal illusion.
Nominal illusion.
Yeah. We are socially conditioned to fixate on the nominal digits in our account. Like, if you have $10,000 USD to pay a fixed $2,000 mortgage, your brain feels safe.
Because the math checks out on paper.
Exactly. You have immediate liquidity to service a nominal debt.
But because we fixate on those digits, we become completely blind to the purchasing power. The sources ran the math on a standard historical high inflation cycle. let's say 6 to 8% annualized over a decade.
Which is brutal.
Brutal. If you park $10,000 USD in a bank account at the start of that decade, at the end of 10 years, the actual real-world purchasing power of that cash drops to roughly $4,600 to $5,300.
So you basically lost half of your wealth.
You lost half your wealth, and you didn't even have to make a bad investment to do it.
You lost it simply by opting out of the economic engine. And in a high-inflation wartime environment, relying on cash as a long-term store of value is a mathematical guarantee of wealth destruction.
Yeah, absolutely.
Cash provides short-term liquidity, which is necessary, sure, but it possesses absolutely zero defense mechanisms against supply dilution.
So if we accept that cash is a guaranteed loss in this environment, it forces a massive question, right? Like, where do you put your money where it won't be diluted into oblivion?
That is the million-dollar question.
Literally. And the answer lies in looking at assets that actually do something. Our 94-year-old billionaire investor operates on a very strict framework regarding productive assets.
Yes.
He argues that to survive a geopolitical shock, you must own things that produce tangible goods or services, regardless of the headlines. Specifically, he isolates farms, apartment buildings, and partial ownership of great businesses, which we colloquially call stocks.
Right, and the mechanism that makes these assets so robust is pricing power.
Okay, unpack that for us.
Well, take a piece of high-quality farmland. The geopolitical situation in, say, Eastern Europe or the South China Sea does not stop a seed from germinating. The farm continues to produce a biological necessity.
Right. People always need to eat.
Exactly. But more importantly, when the central bank dilutes the currency to fund a war, the nominal price of the wheat, corn, or soybeans produced by that farm naturally adjusts upward.
Oh, I see. So the farmer isn't losing out.
No, the farmer doesn't absorb the inflation. The farmer passes it directly to the market.
That makes total sense. And the same mechanism applies to an apartment building, right?
Yeah.
You're providing a non-negotiable human need shelter.
Yeah.
When the broad money supply expands and the cost of living surges, rental contracts eventually reset at the new inflated market rate.
Exactly. The asset fundamentally protects your purchasing power because its output is tethered to human survival and demand, not to a fixed nominal currency value.
And this is exactly how we must analyze the stock market. Because retail investors often view stocks as like blinking lottery tickets on a screen.
Oh, absolutely. Red goes down, green goes up.
Right. But institutional investors view them as proportional claims on the future free cash flow of real enterprises. When you own shares in a dominant consumer staple brand or a monopolistic technology platform, you own a piece of a system that employs human capital, produces real goods, and possesses that critical mechanism you mentioned, pricing power.
Yeah, let's dig into pricing power a bit more because not all businesses are created equal during a crisis.
Definitely not.
If a company manufactures heavy machinery, their input costs for steel and energy are going to skyrocket during a war. That seems like a terrible place to have your money.
Yeah, that makes sense. So how do you avoid that?
Well, you're touching on the vital difference between capital-heavy and capital-light businesses. A capital-heavy business, like an airline or steel mill, requires massive, continuous reinvestment just to maintain its current operations.
Just to keep the lights on and the planes flying.
Right. So when inflation hits, their capital expenditures just explode. But a capital-light business, like a software company, a payment processor, or a dominant consumer brand, they can raise the prices of their products or services without having to spend significantly more money to produce them.
Oh, wow. Because the software is already built.
Exactly. Their margins are protected. They act as a direct pass-through for inflation.
Okay, I follow the logic of a productive asset possessing pricing power. But let me push back hard here, because there is a massive disconnect between this sterile economic theory and the, visceral reality of the stock market.
Fair enough.
When a war breaks out, the stock market does not just calmly adjust its prices upward for inflation. It violently panics.
It does. It absolutely does.
We see massive sell-offs. The sources note that the market historically drops 10% roughly every single year and suffers a 20% bear market crash every 3 to 4 years.
Yep, that's the historical average.
So it is incredibly easy to say just hold productive assets in hindsight. But when you are in the middle of a 20% crash, you don't know it's going to stop at 20%. It could be 50%. It could be the next Great Depression.
Right.
So how does an investor mathematically determine the difference between temporary volatility and a fundamental economic collapse.
That is the defining question of investing. And the answer lies in understanding what the stock market actually is. It is a highly sensitive, forward-looking discounting mechanism.
A discounting mechanism.
Yes, it does not react to the present. It aggressively prices in the probabilities of the future. When a geopolitical shock occurs, institutional algorithms and analysts instantly model the absolute worst-case scenarios.
Like supply chain destruction, energy embargoes.
Regulatory crackdowns, all of it. They immediately discount the future earnings of the S&P 500 based on those extreme risks, which causes that severe, sudden drop in prices you are describing.
Oh, I see. So by the time the average retail investor gets the breaking news alert on their phone and logs into their brokerage account feeling absolutely terrified, the institutional algorithms have already dumped the vulnerable stocks.
Long gone.
They've repriced the entire global supply chain risk and are currently modeling what the economy looks like 6 to 12 months from now.
Yes, exactly. Retail investors are historically the last participants to process the information.
Ouch. That hurts to hear, but it's true.
It is. If you panic and sell after the 20% drop, you are selling at a price that already reflects the worst-case scenario. You are demanding immediate liquidity at the exact moment liquidity is most expensive.
Wow.
The only way a temporary 20% drop in market price becomes a permanent, irreversible loss of your personal wealth is if you manually hit the sell button and lock it in.
Man. But the human brain is evolutionarily wired to flee from a burning building, you know?
Of course it is.
If you see your portfolio drop by $50,000, your amygdala screams at you to run to the safety of cash, to stop the bleeding. But you're saying that in the financial markets, the act of fleeing is actually a wealth transfer mechanism.
It is the most efficient wealth transfer mechanism ever devised.
Really?
Think about it. When you liquidate your portfolio in a panic, those productive assets don't just disappear. You are selling your fractional ownership in the most powerful economic engines on Earth at a fire sale discount.
That someone is buying them.
Exactly. And who is buying them? Rational, patient, heavily capitalized investors who understand that the aggregate earnings power of those businesses will eventually recover.
So you are literally subsidizing the generational wealth of the patient investor with your own panic?
That is exactly what is happening.
This brings us to the great temptation of retail investing, which is the illusion of market timing. I hear this argument constantly from people.
Oh, I bet.
They say, well, I'm not permanently selling. I'm just going to move to cash right now, wait for the geopolitical dust to settle, let the market bottom out, and then I'll buy back in when things look safer.
Yeah.
It sounds incredibly prudent.
It sounds prudent, sure, but it requires 2 consecutive, nearly impossible predictions.
Yeah.
You have to correctly predict the exact moment the market has priced in the maximum amount of fear to sell at the top.
Which is hard enough.
Right. And then you have to correctly predict the exact moment the market will begin to look past the crisis to buy at the bottom.
Which is basically impossible.
The macroeconomic future is determined by millions of multivariate factors interacting simultaneously. There's a concept highlighted in one of our source memos from a distressed debt investor regarding epistemic humility.
Epistemic humility, I love that term.
It borrows from the Anna Karenina principle, right? Every happy, stable economy is alike, but every unhappy, crashing economy is unhappy in its own entirely unique way.
Meaning you cannot just take the template of the 2008 financial crisis, overlay it onto a new war in the Middle East, and confidently predict how the S&P 500 is going to behave.
Exactly. The variables are entirely different. Trying to time the absolute bottom is a fool's errand, and the statistical reality of attempting it is devastating.
Yeah, the math is brutal on this.
The absolute best days in the stock market, the massive violent relief rallies, historically occur within days or weeks of the sharpest declines.
I want to read the exact math on this from the sources because it completely shatters the market timing argument.
Go for it.
Okay, so if you had invested just $100 USD into the S&P 500 in September 1989 and executed a simple brain-dead buy and hold strategy.
Just doing nothing.
Right. Ignoring the dot-com bust, 9/11, the 2008 housing collapse, and the global pandemic, that $100 would have grown to roughly $3,617 by early 2024. But if you tried to be clever, moved to cash during the scary periods, and missed just the few absolute best single days of market performance over that entire 35-year span, your final wealth drops by over 10%.
Just from missing a few days.
Yeah. And if you missed the best 20 days, your returns are essentially cut in half.
because you were sitting in a high-yield savings account waiting for the geopolitical all-clear signal. And here is the harsh truth about the stock market. The all-clear signal never rings.
Nope.
Nobody comes on television and announces that the risk is gone. By the time the macroeconomic headlines are positive and unemployment is low and everything feels safe, the market has already rallied 30%.
Wow. So the risk premium has been removed, and you have to buy back into your assets at a massive premium.
Precisely.
So once we accept that we cannot predict the exact bottom of a crisis, and we understand that cash is a depreciating asset, we really have to stop acting like jittery speculators betting on ticker symbol.
We do. We have to start acting like rational business owners evaluating long-term cash flows.
So I want to ground this high-level macroeconomic theory in some intense historical reality. We're going to look at two specific case studies from the sources that perfectly illustrate this framework in action. Let's start with March 1942.
This is a phenomenal period to study, and it comes directly from the personal experience of the 94-year-old billionaire investor whose philosophy we're analyzing today.
Yeah, I want you, the listener, to mentally transport yourself back to the spring of 1942. The United States had just entered World War II following the devastating attack on Pearl Harbor.
Just absolute chaos.
The psychological environment was beyond terrifying. The Pacific Fleet was crippled. The Axis powers were expanding rapidly. There was genuine, widespread existential fear about the survival of the American Republic.
We are talking about U-boats sinking merchant ships right off the East Coast.
Right. If there was ever a moment in history where hoarding cash, buying gold bars, and hiding in a literal bunker felt like the only rational financial decision, it was March 1942.
The uncertainty wasn't just about corporate earnings. It was about whether the currency and the government itself would even exist in 5 years.
Which is a valid fear.
Very valid. But the rational investor has to look past the terror and analyze the underlying economic machinery. The American industrial base was not destroyed, it was being aggressively repurposed.
Oh, right. Like factories shifting what they make.
Exactly. Ford stopped making passenger cars and started producing B-24 Liberator bombers at a staggering rate. The workforce was mobilized. The underlying capacity for human innovation and production was running at maximum capacity.
So the billionaire poses this hypothetical scenario. Imagine an investor who managed to completely suppress their emotional terror.
A rare individual.
Very rare. They took $10,000 USD at that exact moment of peak global crisis in 1942, and they invested it into a broad basket of the top 500 American companies. Let's assume they bought the equivalent of an S&P 500 index fund, even though the modern index fund infrastructure didn't technically exist yet.
Right, and this is the critical behavioral component here. After deploying that capital, they completely disconnected.
They just walked away.
Yes. They never read another newspaper headline about the war. They didn't panic sell when the Korean War broke out. They ignored the Cuban Missile Crisis.
They held through the Vietnam War, the assassination of a president, the oil embargoes, and the vicious double-digit stagflation of the 1970s.
They simply held their proportional ownership in the productive capacity of the American economy.
The math on that is staggering. If they had simply reinvested the dividends and never touched the principal, that initial $10,000 USD investment in 1942 would have compounded to roughly $51 million USD over their lifetime.
$51 million from a starting point of absolute unprecedented global catastrophe.
It's mind-blowing. It perfectly illustrates that the sheer mathematical force of compound interest, when attached to productive assets, completely bulldozes short-term geopolitical noise. The underlying businesses didn't just survive. They adapted. They innovated. They expanded their margins. And crucially, they raised their prices during the inflationary periods of the 70s, protecting the investor's purchasing power the entire way up.
And this isn't just an anecdotal miracle, you know. The sources detail a comprehensive study analyzing the stock market's reaction to 20 major post-World War II military interventions.
Oh yeah, the data on this is wild.
It reveals a fascinating behavioral pattern. On average, the market experienced an initial shock, falling roughly 6 to 8% as institutional algorithms aggressively priced in the disruption.
Which is the immediate drop we talked about earlier.
Right. But in 19 out of those 20 geopolitical events, it took the market an average of only 28 days to fully recover to its pre-conflict levels.
That statistic is genuinely hard to believe, 28 days. I mean, the conflicts themselves, Vietnam, the Gulf War, Afghanistan, they lasted for years, sometimes decades.
Yeah.
But the financial market digested the trauma, priced in the worst-case scenario, and stabilized in less than a month.
Because the market does not trade on the daily tragedy of a conflict. It trades on the forward-looking impact to global corporate earnings.
Interesting.
Once the parameters of the conflict are understood by the market, once they realize that Microsoft will still sell software and Johnson & Johnson will still sell medical supplies regardless of the conflict, the risk premium compresses and the market recovers.
Are there any exceptions to that rule, though?
Yes, the sources do point out exceptions. When a geopolitical conflict directly triggers a massive systemic commodity shock like the 1973 Arab oil embargo or the 1990 invasion of Kuwait, the market drops are much deeper, often double digits, and the recoveries take significantly longer.
Right, because an energy shock isn't just a scary headline. It fundamentally alters the input costs and profit margins of almost every single business in the S&P 500.
Everything gets more expensive.
It costs more to manufacture goods, more to ship them, and consumers have less discretionary income because they are paying way more at the pump.
Precisely. But even in those severe, protracted stagflation environments, the long-term trajectory of a diversified basket of productive assets remain the absolute best defense against the erosion of wealth.
Which brings us to our second historical case study, the 2008 financial crisis and the mechanics of dry powder.
This is a great one.
Let's set the stage for anyone who didn't live through it as an adult. 2008 was not a geopolitical war. It was a systemic failure of the global banking architecture.
Complete meltdown.
Interbank lending froze. Massive, century-old financial institutions were evaporating overnight. The contagion was spreading from subprime mortgages into the commercial paper market. Main Street businesses couldn't make payroll because their credit lines were frozen. It genuinely felt like the bedrock of modern capitalism was cracking.
And honestly, the panic was entirely rational. People were lining up outside regional banks to pull their physical cash out. Institutional liquidity completely dried up.
But while the entire global middle class was fleeing to the perceived safety of cash, our legendary 94-year-old investor was doing the exact opposite.
Right.
He literally wrote an op-ed in the New York Times openly declaring that he was buying American equities with his personal money. He was aggressively deploying billions of dollars of capital into productive businesses precisely because the macro environment was terrified.
He loves a good panic.
Yeah. The panic had driven the valuations of phenomenal cash-flowing businesses down to irrational, distressed levels.
He was acting as the ultimate liquidity provider of last resort. And because capital was so scarce, he was able to negotiate terms that retail investors simply cannot access.
Right. He wasn't just buying stocks on an app.
No, he wasn't just buying common stock on the open market. He was structuring preferred stakes.
Hold on, let's break that down because this is where the retail investor gets frustrated. What exactly is a preferred stake? Why couldn't he just log into a brokerage account and buy regular stock like the rest of us?
Well, he could, but his massive capital base gives him leverage. When a major blue-chip company or a massive investment bank is facing an existential liquidity crisis and cannot raise money in the public markets, they go to him.
Because he's the only one with cash.
Exactly. He injects billions of dollars in cash to save them, but in return, he demands preferred stock. This often comes with guaranteed massive dividend yields, sometimes 8 or 10% annually, that must be paid out before common shareholders see a single dime.
Wow.
And it often includes warrants, which give him the right to buy millions of additional shares of common stock at a locked-in, heavily discounted price in the future once the company recovers.
So it's basically a sweetheart deal. He gets downside protection through the guaranteed dividend and infinite upside potential through the warrants.
It is the ultimate asymmetric bet. But the underlying philosophy is entirely applicable to the retail investor. When systemic fear causes a broad market sell-off, the risk-reward ratio of buying productive assets becomes historically attractive. As he famously stated, be fearful when others are greedy, and greedy when others are fearful.
Okay, but we have to address the massive, glaring contradiction in the sources regarding this billionaire.
I know exactly what you're going to say.
Right. If holding cash is fundamentally dangerous because of the silent tax of inflation, and if you should always be buying productive assets during crises, why does his conglomerate currently hold over $373 billion USD in cash and short-term treasury bills right now?
It's a huge number.
It is. He is sitting on a mountain of fiat currency while inflation is actively eroding it. Isn't that complete hypocrisy?
It looks like hypocrisy until you understand the profound mechanical difference between a hiding place and dry powder.
Okay, explain that distinction, because it's super important.
When a retail investor gets spooked by a CNN headline about a war, sells their S&P 500 index funds, and moves the money to a savings account, they are using cash as a hiding place.
Yeah.
They have no analytical framework. They are paralyzed by emotional distress. They have no predefined criteria for when or how they will re-enter the market. They are simply trying to stop the psychological pain of price volatility.
They are hiding under the mattress, hoping the monster goes away.
Exactly. But the billionaire's $373 billion is not a hiding place. It is highly calculated patient capital. It is dry powder. His conglomerate's preferred holding period for a business is forever, and they prefer to buy entire companies outright. But right now, their analysts look at the global market, they look at the valuations of public companies, and they do not see prices that offer an acceptable margin of safety for the sheer scale of capital they need to deploy.
The math just doesn't work out for them right now.
The math doesn't work for them at current multiples.
So instead of forcing a bad deal and overpaying for an asset just to get rid of the cash, they wait.
They wait. They park the capital in short-term U.S. Treasury bills, earning a modest risk-free yield that partially offsets inflation. And they observe.
Just sitting on their hands.
Yep. The moment a true systemic dislocation occurs, like a geopolitical shock or an economic crisis that drives the prices of phenomenal durable businesses down to irrational, fear-driven discounts, that $373 billion is a loaded weapon ready to fire. They will deploy billions of dollars in a matter of days. The cash is a strategic, temporary option on future distressed prices. It is entirely different from a retail investor abandoning a 30-year retirement compounding plan because they are afraid of an election cycle.
That makes absolute sense. The opportunity cost of holding cash is high, but the optionality of holding cash during a bubble is incredibly valuable to an institutional buyer. It's not that he likes the cash. He just dislikes the current valuations of the available assets more than he dislikes the temporary inflation tax.
Exactly.
He possesses the emotional discipline to sit on his hands for years until the macroeconomic math is overwhelmingly in his favor.
Can very few human beings possess that level of emotional discipline?
Which is the perfect transition into the most vital part of this deep dive, the actionable takeaways. How do we really take this high-level institutional theory, this billionaire philosophy, and the mechanics of wartime economies, and apply it to your actual portfolio?
Right, let's get practical.
We have distilled 4 core Wealthnetic-style strategies from the sources to help you restructure your financial psychology.
Tip number 1 is fundamentally shifting your cognitive framework. Adopt the business owner mindset.
I really want listeners to internalize this. The next time the market drops 5% in a week because of a terrifying geopolitical headline and you feel that tightness in your chest urging you to liquidate your mutual funds, I want you to run a mental simulation.
A very helpful exercise.
Imagine you spent 20 years building a highly successful cash-flowing factory in your hometown. You own it outright. You know your profit margins, you know your suppliers, and you see the cash hitting your bank account every month.
A solid, tangible business.
If you woke up tomorrow and read that a conflict had started halfway across the world, would you immediately call a real estate broker and demand they sell your factory by 4 p.m. that afternoon, even if it meant taking a 20% discount on its true value?
It sounds absurd when you frame it around a physical business. You wouldn't panic sell your life's work.
Of course not.
You would go to the office, analyze your supply chain vulnerabilities, look at your input costs, maybe adjust your pricing to protect your margins, and you would keep running the business. You would not throw away decades of future compounded cash flow because of a macroeconomic headline.
So apply that exact same intellectual rigor to your brokerage account. When you own an S&P 500 index fund, you are not trading blinking numbers. You own a fractional, legally binding slice of the 500 most powerful, productive economic engines on the planet.
Think about what you actually own.
Right. You own a piece of Apple's supply chain, Microsoft's cloud infrastructure, and Exxon's energy production. You are a business owner. Treat your equity portfolio as proportional ownership in real, adapting businesses and let the executive teams manage the crisis for you.
That leads seamlessly into tip 2. Build a structurally resilient portfolio through authentic diversification.
And we are not just talking about the standard 60% stocks, 40% bonds platitude here, right?
No, you need assets that fundamentally behave differently under stress.
The sources get very granular here. We discussed farmland earlier as the ultimate inflation hedge because it produces biological necessities. But let's look at the most polarizing asset in finance, gold.
Oh, yeah. Gold is a hotly debated topic.
It is. Now, our billionaire investor notoriously despises gold. He has stated repeatedly that it produces no cash flow, it creates no value, it just sits in a vault costing you money to guard. He would rather own every acre of farmland in the United States than a giant inert cube of gold.
And he is mathematically correct that gold is not a productive asset. It lacks an internal compounding mechanism.
Right.
However, the quantitative data from global asset managers like VanEck in our source materials reveals a compelling counterargument. Having a strategic limited allocation to gold, say 5 to 10% of a portfolio, serves a very specific structural function during a crisis.
It is not about growth. It is about decoupling from fiat currency risk.
Exactly.
So explain the mechanism behind that decoupling. If it doesn't produce cash flow, why does its value violently spike when the world is falling apart?
Because gold operates as the ultimate historical hedge against the collapse of institutional trust.
Institutional trust. That's a great way to put it.
Yeah, it is a hard asset with thousands of years of intrinsic, decentralized value recognition. Crucially, it cannot be printed, diluted, or arbitrarily expanded by a panicked central bank.
Which is the exact opposite of cash.
Precisely. When a sovereign nation aggressively debases its fiat currency to fund a war, or when systemic banking failures cause the public to lose faith in the digital financial architecture, institutional and retail demand for a non-sovereign store of value skyrockets.
So it's basically financial insurance.
Historically, during severe equity drawdowns or massive inflationary spikes, gold prices often move inversely to the broader market, maintaining or increasing its purchasing power. It acts as a portfolio stabilizer.
So it's not meant to make you rich. It's meant to ensure that when your equities are temporarily down 25%, you have a uncorrelated asset class that is up 15%, providing you with psychological ballast and, if necessary, emergency liquidity that hasn't been destroyed by inflation.
Exactly. It prevents the total psychological capitulation that leads to panic selling.
Got it. Let's move to tip 3, which is perhaps the most mathematically powerful yet psychologically agonizing tool available to the retail investor practice systematic rebalancing.
It is the ultimate algorithmic defense against human emotion.
Let's walk through the mechanics of that.
Sure. Suppose you sit down during a period of calm and build a target allocation. Let's say 70% equities for long-term growth and 30% fixed income for stability.
Makes sense.
Over the next 3 years, the stock market goes on a massive, uninterrupted bull run. Your equities compound aggressively while your bonds remain relatively flat. Due to that uneven growth, your portfolio naturally drifts. You look at your account, and it is now 85% equities and 15% bonds.
You feel like a genius because your balance is higher, but structurally, you have unknowingly taken on massively more risk than you originally planned.
Yes. Your portfolio is now highly top-heavy and incredibly vulnerable to a sudden macroeconomic shock.
Which is exactly why you implement systematic rebalancing. Whether it's executed annually, semi-annually, or triggered by a specific percentage drift, rebalancing forces you to execute a mechanical realignment back to your target 70-30 split.
And here's why it is psychologically agonizing.
It hurts.
The math requires you to sell a portion of the specific asset class that has been soaring, your big winners, and use that capital to buy more of the asset class that has been lagging or dropping.
You are literally forcing yourself to trim your best performers and buy your losers. That feels entirely counterintuitive to human nature. We want to chase momentum. We want to buy more of the thing that is going up.
But look at what rebalancing actually achieves. It systematically forces you to sell high and buy low.
Oh, right. The holy grail of investing.
Exactly. It strips the emotional guesswork entirely out of the equation. You do not have to watch the news and guess when the stock market has peaked. The rebalancing algorithm naturally harvests the gains at elevated valuations and deploys that capital into undervalued assets.
That's so elegant.
Our sources from institutional wealth managers emphasize that this disciplined mechanical process is how endowments and sovereign wealth funds manage risk. It prevents the portfolio from becoming dangerously concentrated right before a cyclical correction.
It's basically risk management on autopilot.
Exactly.
Which brings us to our final takeaway. Tip 4, right-size your emergency fund. We have spent the last hour meticulously detailing why holding cash is a guaranteed mechanism for wealth destruction due to the silent tax of inflation.
Right, but to be crystal clear, we are not advocating for zero cash liquidity.
Absolutely not. Operating with zero cash is incredibly reckless. Cash serves one distinct, non-negotiable function in a robust financial plan. It provides immediate liquidity for unforeseen, localized emergencies.
Localized is the key word there.
Yeah. If you are suddenly laid off during a recession, if you face a catastrophic medical bill, or if a hurricane rips the roof off your house, you cannot pay the contractor with a fractional share of an S&P 500 index fund, and you can't hand the hospital a gold coin.
You require liquid, nominal fiat currency to bridge the gap.
So the critical question is, what is the exact mathematical right size for that liquidity bucket?
The baseline consensus across the financial planning sources is to maintain 3 to 6 months of absolute essential living expenses like housing, food, utilities, insurance in a highly accessible FDIC-insured high-yield savings account.
Okay, 3 to 6 months.
Now, that parameter shifts based on your personal risk profile. If you operate as a freelance contractor in a highly cyclical industry, or if you are the sole income provider for a large family, prudence dictates stretching that runway to 9 or perhaps 12 months of liquidity.
That makes total sense.
Right.
But the absolute most important part of this tip is the discipline of the ceiling.
The ceiling, yes.
Once you have mathematically calculated that specific emergency number, and that bucket is full, you have to stop. You must brutally cut off the hoarding instinct. Every single dollar you earn above that emergency threshold needs to be immediately and systematically deployed into your diversified portfolio of productive assets.
Because the opportunity cost of excess liquidity is staggering over a 20-year timeline.
It really is.
Do not let geopolitical anxiety trick you into building a bloated 3-year cash reserve that is just quietly decaying in purchasing power. Protect your immediate downside risk with a surgically precise emergency fund, and aggressively protect your long-term purchasing power by owning the productive engines of the global economy.
What an incredible breakdown. Let's bring this massive framework together. We started by dismantling the illusion of cash safety, revealing how governments fund crises through debt monetization, deploying inflation as a silent tax that relentlessly dilutes your purchasing power.
We explored the mechanical superiority of productive assets, farms, real estate, and robust equities, because they inherently possess the pricing power to pass inflationary costs directly to the market.
We differentiated between normal, forward-looking price volatility and the permanent destruction of capital that only occurs when an investor capitulates to panic.
And we analyzed the historical data proving that market timing is an epistemic illusion. The most violent upward recoveries almost always happen while the macroeconomic headlines are still terrifying.
True wealth is systematically transferred during crises from panic speculators to rational, patient business owners.
It's the stark reality of the markets.
Before we close out this deep dive, I want to leave you, the listener, with a final provocative thought. We've covered a massive amount of historical and psychological ground today, but the ultimate test of your portfolio's resilience is entirely personal.
Yeah, I want you to mentally review every asset you currently hold. The stocks, the mutual funds, the real estate. Now, imagine that the global financial markets undergo a massive regulatory shutdown tomorrow morning.
It's just a complete freeze.
The exchanges freeze. For the next 10 years, you cannot get a single daily price quote on any of your assets. You cannot log into an app to check your net worth. You simply have to hold them. Based purely on the fundamental quality, the free cash flow, and the durability of what you own, would you still feel comfortable holding that exact portfolio for a decade in the dark?
Wow.
If your answer is yes, then the daily volatility you see on the news is just noise. You are genuinely investing. But if your answer is no, if you would be terrified to hold your assets without a daily price quote, you aren't investing. You are speculating.
That is the absolute ultimate litmus test for financial peace of mind. Thank you so much for joining us on this Wealthnetic deep dive. If dissecting the mechanics of the market today helped shift your perspective or maybe lowered your blood pressure regarding the global economy, please subscribe to the Wealthnetic channel.
Yes, please do.
And share this specific deep dive with a friend or family member who might be making emotional financial decisions based on the latest terrifying headlines. Keep challenging your evolutionary instincts, keep studying the underlying math, and keep expanding your financial education. We will see you on the next deep dive.